Welcome to this week's edition of Self Wealth Live, the technical analysis edition. Hello, Jason. How are you?
Hey, Roger. I am good. Good to be back on the show to talk some more charts.
Yeah, talk about all the charts this week. It's all happening once again, starting to turn up, or they're turning up and pulling back a little bit. So once again, causing a lot of confusion sometimes from a lot of people I speak to on the phones. But yeah, it's going to be exciting to see what your thoughts are this week, along with answering some questions. We've got a general session once again, asking some questions. We've got a few questions lined up from previous sessions, and then also from some of the emails that have come in through the week for us. So that's fantastic. I'm glad you guys. We keep on getting positive feedback about this show, right? So it's fantastic to hear that that we're doing a great thing here, Jason. Between the two businesses, Self Wealth being the brokerage that I work for, and your service, obviously Motion Trader as well, that you own. So Jason, if you want to go through the disclaimers as we normally would, and then let's kick it off, all right?
Yeah, let's do that. So everything today is general commentary only, no personal advice given. And I'll just quickly put on a disclaimer which just explains all that. So all the so as Rog said, I'm Motion Trader and Roger's from Self Wealth. So my disclaimer's up the top, my licensing details and so on, and Self Wealth disclaimer is below that. So again, everything today is general commentary only.
Fantastic. Thank you for that, Jason. Now, as I've started to do, sometimes I feel like I've got to ask questions that's more relevant to your past and personal trading experiences, Jason. So one of the questions that have come up through the week to me is, how much time do you spend in front of the charts and analyzing this every day? Now, when I first started getting into the education of trading and more so day trading, it was always touted to me that you could do this within half an hour to a few minutes a day, right? So now that I've been doing it for about 6-7 years, I realize it's probably takes a bit longer than that. If you're first starting out, probably could take around that if you do our kind of trading. All depends on what your kind of trading is and what your goals are and all that, right? But let's start with your experience, Jason. I guess my question is, from when you first started, was it a full-time job then, and to now, to your established career in investing and trading now, what's the differences in times that you spend in front of the computer each day?
Yeah, you've got some good questions to kick us off with each week, Rog. I like these. It's it's interesting. So I think back to when I started. So I was in the bank's dealing room, and I'd basically spend all day looking at the charts. And a lot of that's because that was like my job was like I was making making a market in the foreign exchange on the foreign exchange desk. I'm always looking at like what the currencies are doing, and I'm also looking for individual trade ideas. And I could be looking at like a 5-minute chart of a bond future or a 15-minute chart. So there's a lot going on when you bring those time frames down to like a 5-minute time frame. The setups you see is quite similar if you look at a daily chart. It's still this. You get trending phases, compressions in the price action, breakouts. It just happens a lot faster. So when I was doing that, it was a full-time job. I'd sit at the desk each day and look at the markets. Doesn't have to be like that though. It depends what you want to do. So that was my full-time job. But if trading and active investing is something you do as a way to build your capital and get some income maybe through dividends and so on, it's not something that you have to sit in front of the screen each day. So yeah, look, I see these promotions where they say, look, 30 minutes a day and so on. I don't know how you'd be a day trader on 30 minutes a day, because I think you really need to be seeing the price action. But if you take an active investing approach, which is basically what I do now and what I'm doing through the Motion Trader service, it's very little time, if any time, on a daily basis. Several days can go past and I don't several weeks sometimes go past and I don't place a trade. Because once the portfolio is set, it's set. So each day I'll run the data through the algorithms. So it's all algorithmic based now. So I get the data, put it through the system. I get the orders for the next day if there are any. I get my stop changes. I get my exits if there are any. A lot of the time there's not anything to do. So it really can be brought down to not much time whatsoever. A bit of portfolio management time with recording trades in a portfolio tracker software, so you can do your tax and everything at the end of the year. But again, it's just not very time consuming. If I wasn't running a business and doing videos like we are now, I could spend maybe a bit more time if I wanted to be more active in my trading, looking for more setups on a day-to-day basis, maybe some shorter time frames. I enjoy doing that, so I could take that on board, but I'm not doing that at the moment. I'm looking for stocks running for maybe 1 to 3 years, and it just doesn't take a whole lot of time. It's not a full-time job the way I've structured it. But as I say, many different ways to do this. It can be full-time. You can look at charts all day, or you can look at them once a week. It really depends what you're trying to achieve.
Yeah, and I think I'll be honest with you. I think one of the reasons why I started following you, Jason, is because I found a system with ASX trading that I could follow, having a full-time job and being able to look at a few stocks every day, which would take 5 to 10 minutes, and then add them to my watch list and keep on monitoring them over the weeks to see if they've hit my own entry signals. But that literally, as I added to the watch list, I flick through them each morning and see which one's ready to go for my purposes. So it still only takes 5 to 10 minutes. If they go against me, I just remove them. If there's new ones, I add them. So the beauty of it is you can have a full-time role or business or whatever you do, and still are able to do a form of end-of-day trading, right? Where you're reliant on price data at the end of the day, whether you place your orders at the end of the day, after the end of the day, or at the start of the next day. That's what attracted me to this way of doing things, right? But to get to that point, though, I've done, like thousands of hours of learning, right? And so, is that would you say that's correct? How could you quantify like how many hours of learning you've done to get to that point where you're only spending 5-10 minutes a day in front of the computer? Right?
Yeah, well, it is spoken about the 10,000 hour principle or 10 years of purposeful practice in whatever it may be, whether it's in golf or in trading stocks or looking at charts or whatever it may be, playing the piano, it's learning a musical instrument, to to build mastery, not just be okay at something, but to build mastery in something. It's done studies and stuff. It's something like 10,000 hours, and that might break down to like 10 years. So it's a lot. So I don't need to spend a whole lot of time now each day doing this active investing approach, but it's taken, it took all through my 20s into my 30s, learning to recognize chart structure and what can work, how to manage risk, and then that's all then built into an algorithmic platform, which again, took time to learn how to do all that. It took time to learn how to back test. And so, you're right. There's a huge amount of time that goes into the building of a skill. And I think the people who do well in the stock market, it's not just about just following what somebody else tells them to do, but it's understanding the process behind what they're doing. And that's one of the things I do with the Motion Trader service. It's always about explaining the process, because anyone can follow a tip or read something in the newspaper when the market's going up. But it's when the market goes sideways, when it goes down, when it's get difficult, it's the people who understand a full process from start to finish, from when to buy to when to sell, to how to manage the portfolio, to where to set your exit points. They're the ones who stick around and who are here, decades into the future. The people who are just picking a bit of this and a bit of that, it doesn't really work out. So I think you've got to spend that time, even if you can fast track it. I think you can fast track it by getting getting a mentor, even if it's a mentor through a book. It's better, so much better than just trial and error, just sitting there yourself trying to figure it all out. That takes eons. So you're better off getting some sort of mentor, whether it be through book or through some service, or that becomes your platform to then build on. And as you say, all the education you've done, and it all then does help. It all comes together. Even if you don't use part of it, it may be useful for saying, look, well, I know what I shouldn't do, what doesn't work, and then we end up getting where we want to go. And the quickest way to do it is finding the people, or find the people who can help you develop that process, which is going to work.
Yeah, and finding the people that want to do it the way you want to do it a little bit as well, not necessarily the people that it's finding the right people. That's the important thing, right? So to fit your lifestyle, I think it's super important, like in any venture, right? So all right, fantastic. Thanks for giving us a bit of an insight onto maybe we can have a full rundown of your daily schedule very soon, Jason, but we'll maybe another day, right? But it's good to know that what we are teaching people isn't going to take you 8 hours a day, right? What we are teaching people can take you, less than 20 minutes a day, and you can still be an active investor. But to get to there, you may have to spend many more hours than 10, 20 minutes a day, right? So I'm glad we're on.
If you're building a process from scratch, it's going to take you a lot longer. Yeah. If you're, say, adapting to a trend following approach, which is what I do, and there's lots of literature around trend following, it doesn't necessarily take 10 years to understand the concept and the process, and then find a way to apply it. Because I guess there are people like me who can help in that respect. I do the scans, I provide the stocks, and then once you get the stocks, you've got the short list, you can go and look at them, either the charts, or you do some fundamentals if you like fundamentals, and you understand, okay, we're letting winners run, we're spreading risk, we understand that we're cutting stocks which don't work out, because we're going to get losses. That's part of any process. We understand that from the beginning. You don't need 10 years of trial and error to figure that out if you hook up with the right education early on. And then also knowing when to cash out your profitable trades is also another key part of it. And it's about, I think it's fast track it by learning from those who've already been there and who are happy to share their ways, because really there's no great secrets in this business. It's just about pulling the right pieces together and being consistent. And the right people will tell you that, and others will tell you it's really complicated and you've got to do all this. It's not complicated, but it's not easy either. It's straightforward, but you need all the pieces. But pull them together, and then be consistent in applying them.
Yeah, we could talk about forever about these concepts, that's for sure, and we always do, right? But all right, everyone, if you want to put some more questions in there, we will try and get to them today. We're going to kick off obviously today's session with our indices scans. So let's have a look at the ASX to start off with. Thanks, Jason.
Okay, so I've got the ASX 200 for our starting point here, and it's been a fairly quiet week really since we caught up this time last week, and that follows some strong gains over the previous week and a half. So a week and a half of strong gains, and then a week of just gentle sideways. You can see prices break out of this trading range about a week ago. Just when we were talking last week was probably just after they'd broken out. I can actually just draw this range on the chart. We spoke about this a couple of weeks back, and you can see it's a contracting range, and the technical term for that is a triangle, but essentially it's just a compressed period of price action where the price action continues to narrow until you get a breakout. And the thing with these periods of compressed price action is they often act a bit like a spring, in that as the price action narrows and narrows, the spring gets loaded, then ultimately it breaks one side or the other and you get momentum. And that's exactly what we saw. We got that momentum. And so the question is, does that rally off the lows? Does rally off the lows in the last few weeks? Does that mark the end of the pullback? And I think it's certainly a possibility. So you look at what the ASX 200 has done from its peak down to the lows in April. That was a 5.6% pullback. That's a fairly routine event in the course of a rising trend. We get these 3 to 5% thereabout pullbacks several times throughout a year on average. So there's nothing surprising there. Also come back to around the 100-day moving average. So I got the 50 and the 100-day moving averages, overshot a little bit on the downside. That happens as well. So this pullback to that moving average region, that's nothing out of the ordinary either. So the thing for me, so like in trying to work out, is this the end of the pullback? The thing for me is, has there been enough consolidation to support a new advance? So we look at the rally from the October low, so it's 5 months of rising prices, and now we've had a relatively short pullback. And so is that enough? And so my take on this, Rog, is that I think we're probably in for more consolidation. I don't think, like, this is a 3-week decline. I'm just not sure that 3 weeks is a long enough pullback to consolidate that big 5 months advance that we had. And we spoke about ranges a couple of weeks ago. We're talking about what a trading range is, how a trading range forms. And what we've seen so far, it's got the makings of a potential trading range. So I'll show you what I mean. I'm going to give you an example in a sec. But just before I do that, just mentally taking the picture of the big advance, then the decline and the rebound. So if we've got a picture in our heads of that, let me just go back in time. Now, I can find lots of examples of this because it's all pretty common stuff, what I'm about to show you. So I just want to look at this period here. So we've got this is from 2019. It doesn't really matter when it's from because, as I say, there's lots of examples. So we've got a strong rally, not dissimilar to what we've just seen in the previous 5 months. Got a decline back to around just below the 100-day moving average. Again, pretty similar. Got a rebound. So at this point, this is kind of where we are now. So does this look like it's about to go off and make a new high? Well, it certainly could, but not necessarily. In this situation, look what happens next. The market falls again, it rallies and it starts going sideways. Ultimately, it goes up again, but the point is that it took longer. So big advance, it took more than just a down and then back and on its way. It was more sideways. So that's not to say this is going to unfold like this again. That's not meant to be a roadmap for what happens going forward, because these things can play out in all sorts of different ways. It's just to show how a consolidation can start to set itself up. And this is sort of set up in a format that certainly could lead to more sideways action. And I think the thing to remember is that these consolidations can be a bit messy. They can be a bit inconsistent, and they can chop around and cause confusion, frustration. People want it to rally, but it just goes, get this sideways movement. So I think just be prepared for a few, maybe be prepared for a few twists and turns in the weeks to come. It may not just be a case of, okay, that's done and we're up and away. So I think with the strategy I'm using, I talk about this all the time, and I think the repetition is good because it just hopefully ingrains it in like how we can play these things. Is I'm using a wide trailing stop on my ASX positions, and you can think of it like you can think of a wide trailing stop as a bit of an each way bet. So look at it like this. So I've just outlined that scenario of more consolidation. But of course, I could be wrong. Maybe the market does charge higher in the next few weeks. So if it does, well, look, fine. I'm happy to be wrong on that possible scenario, because I've still got all my long positions. Well, mostly I've got a large long portfolio with those wide trailing stops. So if the market goes up, well, I'm still in my positions. I can still do still do well from that. If the market consolidates, if it does go sideways, then hopefully those wide trailing stops can help me see off a sideways period or another dip to the downside. Hopefully I can see it off. But if it turns into a larger sell-off, well, then I have exit points below the market which gets me out. So really, it's all about it. I think this one strategy covers several possibilities. So it's not about predicting. I don't think we have to predict what's going to happen next week or next month, but I think we need to have that strategy which helps us react to the price action that we do ultimately get.
Yeah, thanks, Jason. Let's have a look at the American market then. There's a few questions in there around the US actually, so let's have a look at that one.
And this has been a bit like the ASX 200 in that it's been a constructive week generally for the US market. It's been gathering some momentum since coming off this 100-day moving average last month, and so similar to like what we're talking about with the ASX 200, it's like, is this about to resume the upward trend, or is this part of an ongoing consolidation? And you only need to look back to last April. So come back to April last year, and it's like I was saying with the ASX 200, that example I showed you from 2019. And I said, look, you can find these all over the place. Well, here's an example in the US market, but this is just from last year. So similar story, a nice advance, downward move, a rebound, which looked like maybe it was going to keep on going. And I think plenty of people thought this was going to keep on going in August last year. They thought that was enough and we're off to new highs. But as we turned out, it turned into a longer consolidation. The market fell away, and it took a few months, took several months before things ultimately bottomed and got going again. So it's again, it's not to say the same thing's going to happen this time, but I think the next few weeks, the next few weeks are going to produce their own unique price action. I think the important thing to do here is just keep an open mind and be aware of the various scenarios that could play out. Yet the market could rally, but again, I'm favouring more that we do see more sort of sideways chop, more consolidation, and I think the approach here, I think the approach at this point, I think it's about being cautiously optimistic. I think the overall trend here, when we look at this, Rog, the overall trend is certainly up at this point. Above moving averages, that's all positive. I don't see any evidence to suggest otherwise. And we're also seeing that buying interest on pullback. That's also positive. So I think there's good reason to be bullish. The cautious components, it's just about the timing. And my thinking is it's been a big rally off that October low. I just think it needs more time to consolidate. Big rallies often lead to several months of backing and filling. That can then establish new platforms, new support. That can lead to higher levels, but it often takes time to play out. I was also looking at the NASDAQ equal weight, which is an interesting one to have a look at, as opposed to the NASDAQ 100. This is an equal weight version of the NASDAQ. And just looking at this price action, it's got quite a bit of distance to go to get back to its previous highs. It's only really come about halfway back, so it's further back than the S&P 500 and the NASDAQ. It's struggling to get above its 50-day moving average. It's just getting above it now, but it's taken longer to do so. Price action just seems a bit heavy to me. It doesn't look ready for new highs. This is just one component of the overall market, but it just could be one of those clues that we are heading towards some more consolidation. So from that perspective, I'm just being a bit conservative when it comes to buying. I'd rather see some more consolidation and buy a breakout. That said, entirely comfortable holding my long positions, and as we were just talking about, it's wide trailing stops with the objective of trying to see off any further consolidation. And but if I'm wrong, I've still got plenty of players on the field, plenty of open positions, but managing that risk all the time. I've got to manage that risk.
Yep, very good. All right, let's have a look at the Hong Kong market.
And over to Hong Kong, and this continues to gather pace. Talking last week was just in this little sideways trading range, and it's broken high in the last few days, running up. And what would this? This would be its highest level since August last year. So it's having quite a bit of a run. We've been talking about the ingredients for that upward trend being in place, and now we're really seeing that momentum develop. Probably no longer an asymmetric entry point after several strong weeks. I'd rather wait for some consolidation now to consider, like, look, is there another entry point? But if someone was buying it as it was breaking out of this trading range a few weeks ago, it's something I'd certainly be holding on to and giving it plenty of room to move, seeing where it goes. Similar thing going on over in the Chinese market. Chinese stocks haven't been as dynamic as what we've seen in Hong Kong. I think those building blocks of an uptrend are still there. So we've got the rising moving averages, we've got the price above the moving averages, we've got this little sideways range which it's currently moving in. It is starting to pull a little bit to the downside at the moment, but that overall momentum I think is still in place. Couple of ways this could be played. If somebody wanted to take a position could be taken now. An exit point could be just below the 100-day moving average. I think that's about 5%. And I think that's asymmetric because you look at where this could go. Like there's this overhead resistance, which has been a significant level for several years. That would be if the momentum does get going, that's sort of where you look for it to go to. So that's about 15% away. So you say a 5% exit point on potential 15% upside, and then a break above there, potentially even more still, but that's getting a bit of ahead of ourselves. So it's asymmetric in the setup. The alternate would be just to see how this plays out. Does it continue to go sideways and then buy a breakout? But if it doesn't break out, well then you can just let it go. If it doesn't break up and it does start to drift lower again. So I think there's certainly potential in the Chinese market, in the Hang Seng. So it's early stages with these, but they're definitely markets of interest.
Yeah, and obviously the reason why we sort of analyze the Hong Kong markets, if you didn't already know, is that we do have access to Hong Kong stocks on the Self Wealth platform, right? So not only can you trade ASX and US shares, you can also trade Hong Kong stocks. So in terms of China, I believe you can get access to a China ETF through the ASX as well. So Jason showed you an index there to be able to trade that Chinese market. So I believe you could probably search for a China based ETF on the ASX market, right? So giving you access to global markets and not just the Australian market, right? So if you're interested, obviously. So, all right. Thanks, Jason. Now we've got a few questions here. First, a little statement, and you probably agree with this, Jason. Missing a show like ours is like missing a Blues win in an Origin game. Yeah. Would you agree with that? Or
oh yeah. Yeah, well, it's like, well, I've got to be a Blues supporter, don't I? So it's nice to hear that someone thinks missing the show would be like missing a Blues win. So I wouldn't want to miss a Blues win. So I'm glad someone's thinking of the show along the same lines. Hopefully the Queenslanders can just flip that comment and replace Blues with Maroons, and it works for them too.
That's right, and no comment from me as a Victorian, right? So, but that's all good. All right. So the first question, which I will start from here, and I'll try to make. Maybe this is a quick one because there's a few we've got to go through, even from the previous week. How do you manage currency risk on US shares, Jason? I mean, you trade the US markets a little bit, not that much, is that right? Or
it's with some of the ETFs you can buy. You can buy ETFs, hedged ETFs. So you can buy a hedged S&P 500 ETF, which is something I've done in the past because when I was holding an S&P 500 position up until only a few months ago, I had the hedged version because I thought maybe if commodity prices ran, the Aussie dollar might run as well. The commodities ran, but the Aussie didn't run. So in hindsight, didn't need to be hedged. But that's why I took on the hedged version. with the individual shares, it's a bit more cumbersome to hedge. Like it can be done if you've got a CFD account. You can if you buy US shares, you can then go and hedge by placing offsetting trade with an Aussie dollar CFD, for instance. But that's a lot of mucking around, I think, for a lot of people. I don't do that myself. I tend to just wear the currency risk most of the time, and less like, and that's been easy to do over the last few years because the Aussie dollar's generally been declining. So once you've transferred your Aussie dollars into US dollars to hold the US shares, it's been a tailwind because the Aussie dollar's been declining. If we go into a period where the Aussie dollar is consistently in an upward trend, well then maybe some more consideration needs to be taken, because then it becomes, of course, a headwind. So you might pick up 50% of the stock, and then you get revalued downwards because the currency's gone against you. But for the most part, I don't hedge the currency risk with the individual shares. I may do so with an index because it's easy to do. But yeah, it's something we need to consider, but it's more a consideration when we're in a period where the Aussie dollar is rising.
And it's a great question, because if you do trade US stocks, you might not be aware that if you've got a strong Aussie dollar, the profit that you might be making in a US share might be diminished. But like you said, it's you need to be aware of it. I think it's a good, and I think most people probably wouldn't be aware of these sort of things. We certainly get queries as to what's happened to all my profit when they change it back to Aussie dollars. So if you're trading those markets, definitely be aware of our currency risk. It's a huge topic, right? So I probably can't cover it all. But thanks for answering that, Jason. Let's get on to one of the questions around from last week. It's a bit of a long one, so let me read it out here. Jason, this is from Michael. Jason, you mentioned the building blocks of breakout from the bottoming pattern. Would you please ask the building blocks of an interim as well as a major top before it breaks lower? So what are the building blocks of an interim as well as a major top before it breaks lower?
Yeah, it's good, really good question. It's really the opposite of what you're looking for in a basing pattern. So I'll get a chart and we'll see whether we can find an example. So let's see. I'll just have a couple of stock codes which are in mind. Whether I find the right type, I'm not quite sure. Yeah, this. So this is Linus Rare Earths. This is a good example. Yeah, look, we can work with this in that when we're looking for a low in a stock, we're looking for a period where you get a downward trending phase. Prices are below the moving averages, and then you'll get to a point where like there's all sorts of recoveries. You can get like these V-shaped recoveries which come down and then go straight back up. More often, I think you probably find you get these sort of like rounding type bases where the stock loses its downward momentum, finds its way above the moving averages. The moving averages cross, and then that's when we start looking. These are the building blocks of an upward trend. We've got price goes from below the averages to above, moving averages start rising, and the upward trend starts to engage. So we're kind of looking for the opposite on the downside. It flips, so it's a mirror image. So I can just use this period here where price has been rising, gets to a point where price comes back to the moving averages, starts to move around that moving average a bit. So we're in a bit of a point where we don't really have upside momentum. The upside momentum's on pause, but we don't have downside momentum yet. Then we get the price comes breaks lower again. So now it's spending time below the moving averages. The moving averages cross. We've got a sideways period. So this is like, if you're looking at this in real time, you can see the vulnerability. The vulnerability here is that the price action is now starting to spend more time below the moving averages. So it's not, at this point, you don't say this stock's in a downward trend, but it's you're worrying that it's starting to lose its footing. So then a break below a previous low point then potentially opens up downward momentum, and that happens here. So the downward momentum, it breaks a previous low, and the downward momentum picks up. It's now trending below declining moving averages. So this is where I'd say, this is where I don't want to be in a stock. I don't want to be in a stock like this, and this is where my trailing stop will kick in and take me out. So I'll have a wide trailing stop, so I can often see off the price action in this early stage, relatively early stage. But as it starts to gain momentum, the trailing stop will trigger, and I'm out. And then you see what happens. Sometimes the price action will extend to the downside. Other times it will base and then turn back up. This fell for several months, based, and then we go through the process again, bottoming above the moving averages, and we get the building blocks on an upward trend.
So sorry to interrupt there. Just as you move your mouse over that area, there was that massive gap. It's actually probably answers the next part of that question around gaps. Are they important parts of it? Signal change, basically.
Gaps are interesting. I like to couple a gap with volume. So we can just put on volume on this stock. And I don't know what we're going to see when we do this, but yes, that was a high volume day. It's this gap I'm less interested in, because it's gone from below the moving average. It's gapped up. At that stage, the moving averages hadn't crossed yet, so I'm less inclined to want to do something with that gap. The gap I do like, I just see in the chart, which I do like, is this one here a few months later, where the price consolidated, started to rally off the moving averages, and then it gaps again, and it's on a high volume day as well. So you can see the volume on that. So it's so for me, that's a sign that there's a lot of money wanting to move into this stock, and it probably hasn't all been done on one day, and we've got the underlying momentum is now to the top side because we've got price above the moving averages. This is sort of gap that often leads to further rises. So that's a gap I'd probably like to play. There's also other gaps. They're called exhaustion gaps, where a stock it's been going up vertically, and then we'll have one more gap higher, and then it will start to pull back. But there's not a quick go-to example on this chart. Oh, look, it's like, well, this is kind of like I'd be concerned buying this type of gap, because it's not really, it has, it's not really rallying off the moving averages. It had been stretched. It came back a little way and started rallying again. We've got that big volume surge came through it, gapped again, but it's gapped higher from a position where it's been running for a long time. It feels stretched above the averages, so this is a gap I'm probably not inclined to play. Like, I know the outcome here, I know it falls, so it's a little bit cheating trying to say, you can pick the price action on it, because you can't, because sometimes, look, maybe it goes up further, like we saw that in the coca price recently, where it just kept gapping up. But there's some gaps which have, I think, carry more risk. I think ones where the price has been rallying for a lengthy period and getting stretched above the averages, I'm not so keen on those gaps. It's like, I like those early gaps where the price is just starting to lift off, and then you get a gap on high volume, and that can be a sign that there's we're at the early stages of an ongoing move.
Okay. All right. Fantastic. All right. Let's have a look at one of the questions from the viewers then. From Kirby, do you have an indicator or method to monitor the health of the general market to inform how aggressively you trade?
The moving averages. It's like I'm always like with indicators. I don't use many indicators. It's really, for me, the moving averages is the key indicator. And the question to ask, where is the ASX 200, all the All Ordinaries relative to its moving averages, and what are the moving averages doing? So at the moment, the moving averages are flat, and the prices like moving either side, moving either side of them. So we don't have I don't think there's a near-term trend in place, and so we're in a little bit of a holding pattern. If this kicks up higher in the next few days, well, maybe the uptrend can re-engage. It's what we spoke about earlier. But that's not the case at the moment. So the possibility is there that it does keep back and forth over those moving averages. Whereas a few months ago, it was a case that, prices were rising above moving averages. Now, at some point, they will peak and they'll pull back as they have done. But when my general positioning towards the market or view towards the market is typically going to be positive when it's rising above those increasing moving averages. Unless, of course, it's become stretched, and then we say, well, look, it looks like maybe there's some pullback due. Maybe it's not an asymmetric entry point into the market because it has run a long way. But that would be for me, that's the indicator. Where is the market relative to those averages?
Yeah. Okay. Fantastic. All right. Let's go back to a question from the week gone. So are you okay to show your overall performance against the market the last couple of years to a year?
Yeah. Can do that. So I've got the my self-wealth portfolio. So I'll just jump into that. So we'll go to the so with the self-wealth. So all the self-wealth users, clients will know. You go into portfolio, and then you go my performance and stats. Click on that. And we get a graph. So my portfolio is the green. The ASX 200 is the blue. So this is for the last 12 months. I can't show much beyond there. I can click on 24 months, but I only opened my self-wealth account in when was it? It was February last year. So I don't have 2 years worth of data. So my portfolio stops at this point. So there's no point looking at the 2 year view because they've got different start points. So going to the 12 month, and that's the that's my portfolio over that period. So look, there is some nice there's some nice outperformance there. If you want to see my portfolio over a longer period, you can just come to the Motion Trader website and just scroll down, and this update's almost live. That's so what I did it was October 2015. I thought, look, what I should do, it comes back to that old saying, if you're going to talk the talk, you should walk the walk. So I thought, if I'm going to provide people with signals for stocks, I should show that I do it myself. So I purposely set up a standalone portfolio. I put 500,000 into it, and that was just for trading the Motion Trader signals. Well, as many as I could with that capital base, and I also aim at the smaller end of the market. And then this shows the performance of that 500,000 cents. So it's not showing the starting capital. So you can see it starts at zero. So it excludes the starting capital. It's showing the profits. The profits over that 8.5 year period includes the dividends, includes costs, includes franking credit. So everything that's gone into my portfolio over the last, all the profits that's come from it over the last 8.5 years. So it's, there's more than $1 million worth of profits over that period. So we can compare this to the local market. So the self wealth one, we can only go back 12 months really. But so okay, so there's about a bit over $1 million worth of profit. About 3/4 of that is from gains. About 1/4 is from dividends. So I think the capital gain component is about 850,000. So 500 starting point. It's double the 500 and then a bit more. So I think it's about 160,000, 150 to 160% gain over that period. Then you can compare that to the All Ordinaries over the same time. So I'm taking out dividends because you've got to take out dividends to have a like for like comparison. If you just compare the overall profits, including dividends, you look at the All Ordinaries as not including dividends. So it's not like for like. So that's why I'm taking out the dividends and that back of the envelope calculation I'm doing. Going back to 2015, where I started, was around this point here. The market, what's that? The market's up about 50%. My portfolio is about 150%. So I guess you'd say from that perspective, there's been some good performance. But I think Rog, the key to that is it's not that like I've got this special ability to pick stocks by any stretch. It really comes down to just having a robust approach, having a repeatable approach. I think is probably, it's coupling those two together. It's having a repeatable and robust approach and then applying it consistently over time. That's really what that comes down to. So what I'm doing, rather than trading the market as a whole, so that's the ASX 200, or you take the rather than trading the all ordinaries as a whole and having all 500 stocks, I'm essentially cherry picking because I'm using that momentum. So I'm only looking at stocks which are above rising moving averages. So that automatically culls a fair percentage of the market. I just won't look at, so they won't be under consideration. So that's why I say it's cherry picking. It's taking stocks with the right market structure. If they keep going up, I'll let them keep going up. If they stall, I'll kick them out. If they, I'll spread risk because I don't know which stocks are going to deliver the best performance. I've got to have a portfolio of them. And if I get a really good one that runs for a year or two or three, and then ultimately it'll stall and fall back as well, I'll jump off and then bring in a new player. I won't just hold it all the way back down because it's a favorite stock. So it's all just that repeatable process. That's what has helped me create the performance. It's not about having a magic entry trigger or some insight into when to sell. It's just simple rules applied consistently. And when we say simple rules, it doesn't mean that it's dumb rules because it's simple. It's dumb. It's sophisticated when it all comes together, but it's straightforward as well. It doesn't have a whole lot of moving parts. It isn't complex. It's and I think that's what makes it robust over time because it's not complex in that it has too many pieces trying to move together. And you keep things simple, and that's what can happen when you do so.
Yeah, look, I think the important point to note as well, once again, is if you look at your website graph there's a lot of down periods in that even though it's trending up all the way, there's a lot of down periods you got to sit through, right? And how many people have the stomach to do that before they give up, right? So that's over an 8-year period. And look, past performance doesn't equal the future, right? We all should know this. We all probably don't know this. So, how many of your clients, and I mean, this is a rhetorical question, so you don't need to answer, but are able to stick for it for that long to be able to see those gains, right? So it takes.
Not everyone can do it. Not everyone can do it, Rog. Certainly, a lot of people can, but a lot of people can't. Mm-hmm. And like people will see a graph like this and just see the big sweeping upward trend, but you got to also note these periods where you have the declines, and they can last. That can be like a 12-month period where just not much is happening. So this is where you've got to be consistent and stick to your process and accept that losing periods are part of the process and you're going to give back money. And one of the things that I'd noticed from a lot of people when they come through, they don't like to give back money. They want to protect every dollar of gain they get, and they don't want to let their stocks have room to move because they're always trying to shut down volatility. But if you shut down volatility, you really shut down the potential for these gains, which are achievable, but nothing. They talk about there's no free lunch. Like you get nothing for nothing. So if you want to get these big gains, the cost is you've got to be able to sit through a reasonable amount of volatility. Now, I say reasonable because it's not about riding a stock down to 90% and holding on and then it comes back again. That's just ludicrous. And you can't do that. But it's about giving it 25, 35, sometimes 40% if it's a stock with that amount of potential movement, giving it room. You've got to give it room to see off those periods where most people seem to get shaken out and stay on those big trends for as long as possible. But having that calculated exit point, this is a consistency which I think a lot of people lack. It's too ad hoc and they're going, I'm feeling bad about this, I'm going to sell, or it's too late, I can't sell, I'm going to buy some more. And all this stuff goes on. A lot of it can be avoided with a good approach applied consistently.
Yeah, exactly. All right. Let's have a look at another question here. What's the best way to sell low liquidity stocks? It took a while recently to sell a motion trade exit stop after it fell below it. And I found out that there was an issue with the CEO misconduct. But anyway, in general, what would be the best way to sell a low liquidity stock?
Yes, sometimes you've got to be a bit patient with the low liquidity stocks. And it's low liquidity stocks can provide some really good opportunities. That some of the biggest trends start off as low liquidity stocks. By the time the trend finishes, they're probably not low liquidity stocks because a lot of interest has come into them. But in the early stages, when they're just because they're off the radar, they're typically outside the ASX 500 or outside the All Ordinaries. No one's following them. There's just not much liquidity there. But this is where, you decide, if you want to be in something at a really low level, then you're sometimes going through some of the low liquidity stuff. If you don't like low liquidity, sometimes it's a case of letting the stock get a bit bigger and some liquidity comes a bit easier. But if you are looking at low liquidity, sometimes it's about being a bit patient. I'll see whether I can get an example. So let's just go back to the go back into self-wealth. There's because this stock comes to mind because it hit its exit yesterday. It's a motion trader stock. Let's have a look at the chart first. So this is Ainsworth Game Technology, and it triggered a signal in December. This is how it looked in December. Looked pretty interesting in December. So it had an upward period, it had a big consolidation, sideways period, and it looked like maybe the momentum was returning to this stock. Right structure, price actions above the moving averages, rallied for a few weeks, and then it just took a turn for the worse. Started to reverse. Initially stabilizing around the moving averages, so it was still in play, but then it's just gap lower, not gap, but it's fallen quickly just in the last couple of days, and hit an exit stop. So how would I exit if I was holding that stock? So let's just have a look at the market depth. And yeah, so you can see there's not a lot going on the bid. So there's only these are sometimes you hit one of these where it says 65 or 38, and there's actually some more volume appears appears behind it, but you can never be sure whether that's going to eventuate. So if I was trying to exit this stock now, so look at that. Now I come back and look at the price action. What often happens? What often happens when a share falls rapidly, it gets so stretched below these moving averages. Often it will rebound over the next few days, or maybe over the next week or two, particularly in the low liquidity ones, because there can often be just sell at any price on the way down. So the move's really accentuated to the downside. And then once that selling dries up, it snaps back somewhat. So wouldn't be expecting to snap back to where it fell from, but maybe it could come back to 96, 97. I'd be looking for below $1, because $1 is a bit of a round number. People look to sell at $1 who want to get out. So I'd go a few cents below that and think, look, what about 90, say around 90, 96. And what I might do is I could put in, I'm just looking now at the offer side. There's not a lot to sell on the offer either, with the exception of like 60,000 shares at 92. There's not a whole lot going on there either. So I might put in a sell order at 95, 96. And if we get that rebound, then often I'll be able to clear out my stock that way. What I might do, I might also want to de-risk my position. So I might say, look, there's I can get a third of my position away. There's 7,400 on the bid, another couple of thousand, half a cent below. I might want to de-risk it by saying, look, I'll get away a third of my position now. So maybe I'll just put in a sell order to sell down to 88.5. So I know I've got a bit away, and then put the balance up here at 95 and just see whether some volume comes in over the next few weeks. So the risk with that is the stock continues to fall away. But unless the stock's going out of business, at some point there's going to be a rebound. It's going to correct back towards the moving average. I'll show you another stock I did this in recently. It was Duratec. Duratec hit, where was the day? Let me just find it. It was this day just in here. So Duratec triggered the stop loss during the day, traded up, closed near the high. I sold it the next day when it traded up, and then started to, maybe it was the day after. So it was a couple of days after it traded up, then it started to fall back again, and I sold. So stop loss was down here, but I got out here because I was just getting that little bit of a rebound back. Ended up getting a larger rebound back later on, but I don't want to get too fancy with playing around with the stock which is falling. I want to get out. I don't want to say, oh, look, I'm just going to hold it and wait for a rebound to get out better. I'm really just trying to play off a situation where it's stretched below the moving averages and looks like it should just tick back a little bit once the initial panic of the sell-off is done. But again, the risk is that it doesn't rebound. That's why I might just like sell some of that stock instantly. But then I've also got to monitor it. If it keeps falling away, well, then I'll just end up just selling it regardless and just saying, look, I'll take a bit of a larger loss, but I've got to get out. I just can't keep holding and hoping there's going to be a rebound.
Okay. All right. Fantastic. There is some pretty big questions in there. One's around risk reward, Hamish. I'd love to answer that. We'd probably have to spend another 2 hours here, but there's so many of our previous sessions that talk about this, as well as the Firehawk question around mitigating risk. I think we all know now why Jason mitigates risk by having those stop losses, and there's unlimited upside by having those trailing stop losses. But yeah, if you want to visit some of those, we might revisit some of these questions next week. But there's plenty of that material over in our previous sessions. Just look out for the headings around risk reward, and then using stop losses as well. All right, so that's to answer those questions there. I think, Jason, we might leave the general questions for the rest of it. We'll get on to some stocks. Let's have a look at, if that's okay with you.
Yep, let's go.
Let's look at MEI.
Okay, MEI. Yeah, so this is involved in gold I think it's still range bound. Just looking at this is why we always need to compress the price. A lot of the default screens will just give you like 1 year. Just compress it, see where it's come from. A big upward move, and now we're just getting this big consolidation. You can just see it's just like locked in the range. There's nothing. I don't think there's anything immediately to do here. If I was holding it, and I'd been holding it from way back, I'd continue to hold it in the range and just give it room to move within this range, because it could well break to the upside. So in that were the case, I'd want to still be on board. But I'm not doing anything with this at the moment. It's below the moving averages, so it just becomes, brings in a little bit of vulnerability. But look, it's been below the averages previously and then come back, and this is a range. It oscillates either side of the averages. If I wanted to go for an early entry into this one, I'd be looking at these previous highs around 25.5. So if it were to stabilize here and rally and stabilize and rally back up and then break higher, well, then this would be this could be an entry point. But that's not the case at the moment. So this is one to watch.
Okay. All right. What about HGO?
Yeah, this is an interesting one. Very interesting. Yeah, I like the strong rally from below the averages to above, and then this sideways consolidation back to the averages, and now it looks like it's breaking higher again. There's the makings of a trade there. The way to play it, you could possibly give it another. So it's a low price one. So maybe 8.5 cents, maybe. That could be a buy. Just work out what the risk is on this. So perhaps, the like one strategy would be putting a stop below the low from a week or so ago. Also gets you below the 100-day moving average. That's only about 16%. And when you're looking at an 8.4 cent stock, to be able to get a fairly close stop on it is a good result, because this sort of stock could double. And for a 16% stop, that's highly asymmetric. A little more aggressive would be maybe the midpoint of the range. That's probably about 10%. So downside is quite manageable and plenty of upside potential. One to consider if you like low price speculative stocks, particularly if there's a fundamental reason that you like it as well.
Oh, fantastic. IEL.
This is a no, because it's just below these declining moving averages, and it's been the case for ages. I don't want to try and pick a low on it, because why should the low be here? Why shouldn't the low have been back in February at a higher price, and back in December at an even higher price? It's like it's trending lower. We don't know how much lower it will go, so I find it best in these situations just to step aside, put this one on the back shelf. No need to look at it every day. It's just wait for it to get back above the moving averages. That could be in a. You'd probably look. It'd probably take at least a couple of months for it to start to turn around, unless it got like a big gap higher. So there's nothing in the near term to do here, I don't think. Wait for it to get above the moving averages, wait for the structure to improve, and then consider it. But while it's in a downtrend, just leave it alone. And this is why I say early what I said earlier about cherry picking. This is a part of the market I'm avoiding. So this will, stocks like this make up the all ordinaries as well. So I just steer clear of them. They can decline for as long as they decline for. If they get above their averages, well then great, let's have a look at them. But until then, I can remove a big chunk of those top 500 stocks by just avoiding the ones which are below declining averages.
Yeah. All right. What about A2M?
Yeah, it's got the makings of something interesting. For me, it's like I was saying with the ASX 200 earlier. Is this going to be part of a longer consolidation? Because it wasn't big rally this stock has had. It's only really just started to retest the moving averages now. So often you see stocks will, yeah, you see it come more like this, and then perhaps up, so you get more of a sideways motion into the moving averages. So my hesitation with this at the moment would be, will it come back down and retest the April low as part of a larger consolidation? So if I was in this, I'd certainly be staying in. I have my wide trailing stop, see off a further consolidation if that eventuates. If it continues rallying from here, great, I'm on board. If I was thinking of buying, I'd probably just be patient here and wait. Also keeping in mind what I was saying about the ASX 200. If it's to go sideways, well then that probably dampens the potential for A2M in the near term as well. So I think there's a little bit of extra risk with entering at the moment, but it's a stock which I'd want to keep a close eye on. I think there could be a play there.
Okay, fantastic. EBR.
Above rising moving averages. It's this is interesting stock. Like, I like that rally off the moving averages recently. It's had the pullback, but it looks like it's finding support on the pullback. Whether it needs more time, that's entirely possible. But the overall structure is good. If I was in this, I'd stay in it. It's one I'd consider buying. Do you buy it here just above the moving averages, or do you give it more time? That's a bit of an open question. I'd probably give it a little bit more time just in the current environment. But if we get some sideways movement back to the averages, maybe buy it on the averages or buy the breakout higher if that's the price action that develops.
Okay. IRI.
Yeah, I was talking about this in my weekly strategy session on Friday. Really interesting stock. It's if I was in this, I'd certainly be staying in it, but I probably wouldn't be buying it now. Not now. It's just had that big run recently. Now it's a case of, like, I've just got to watch this one, see how it consolidates, and then consider it from there. It was a motion trader signal in April, late April. So you can see it went from below the averages to above, broke to a new high. That was a signal, had a brief pullback, and then there was an announcement, and it was up and away. But this is why we look for momentum. Momentum's it's like looking for ripples. We're looking for ripples in the water. And so this was your classic ripple. It's a market cap of $70 million. I think it's profitable. They definitely got revenue. They got 20 million in the bank, no debt, but it's 70 million. How are you going to find it? It's lost in the plethora of stocks outside the all ordinaries. But you do find them by looking for the ripples of price action through momentum scans. So it did show up. So it gave the opportunity to get a position, and it's been a great one. They don't all do this by a long shot, but that's how we find them before they appear in headlines, through looking for the momentum, looking for the ripples, and some of the ripples turn into waves, and then you ride them in, and that's what momentum study is all about.
Yeah, don't we wish all our stocks look like that? But certainly not the case.
And you don't need them all. You just need a portion of them. You just need maybe 10% of them to go into triple-digit territory, and you really have the makings of a great portfolio, provided you're also protecting your risk on the downside as well. And you're going to have that big middle tier of stocks which do good, solid double-digit returns. And you're going to have your loss makers, but you keep your loss makers relatively small, and they don't do too much damage. So then the ones that do go, maybe your top 10%, which can go triple digits, that can really lift your portfolio, and that's where you get the outperformance. And that's kind of what I was showing in my portfolio earlier. I'm just keeping that downside rigidly under control, but I've left the upside uncapped. And when you leave the upside uncapped, you get a few runners and the whole thing can really start to come together. But you don't need them all to go gangbusters, just a portion of it, and don't limit how well they can go.
Yeah, exactly. All right. And what about CXL?
Calyx. This is one of my own portfolio, as well as a motion trader stock. I made about 500% in this one. You wouldn't think so looking at this, would you? It looks like this is a disaster stock, but we've actually got to compress the price action a bit. It's a boom bust stock. So I've got some markings on there because I've spoken about this at other stages. This is where I bought my own position. It's not dissimilar to integrated research in that, like, how would you find this? And you'd find a stock like this through, again, the ripples in the water, and below the moving averages to above, broke to a new high. That was my entry point. Initially surged like our IRI, and then it came back. This is why I say with integrated research, I'm hesitant to buy after such a strong surge above the averages. I'd like to see how the consolidation plays out. Not to say it's going to play out like Calyx did, but it could. So Calyx came back. So I went from an initial strong gain to this stock was in a loss. And a lot of people struggle with this. They go, oh, well, I can't have a stock which has gone up 20% now in a loss. But this is why I use those wide stops. So I can see off a reasonable amount of volatility. Came back, then started moving higher. Don't cap your upside. That's what we were just talking about. Leave your upside uncapped. And this one ran and it ran and it ran, and then eventually came back, hit the trailing stop, 500% profit. It's an entirely achievable outcome if you apply the right process and you just give the market time to do what it does, and don't try and protect every dollar of profit with a tight trailing stop, because you've got to be able to see off these pullbacks which happen along the way. As for now, well, you can see why I'm glad I had a disciplined exit point, because it's been in a tailspin ever since. And it's still, for me, it's still in a void. It's still below declining moving averages. It looks like it's losing some downward momentum at the moment. So it's interesting from the perspective, like, is this going to base here and start to turn higher? But who knows? We don't know. But I don't want to guess at these things. It's, if you use 10 and 20-day moving averages, you get an earlier turning point, but you also get more false signals. So like, if you're using 10 and 20-day moving averages, you would have got buy signals during this period. And that's okay. You can manage risk around that. It's just going to be more active. You're going to get more stocks that don't follow through. But any which way I look at this, maybe I could keep an eye on it, but it's like the other stock we looked at, the education one, IDP Education, I think it was. I'll just wait for it to get above the moving averages. I don't need to get in at the low. I'll give up a bit of upside, get in at a point where it's above moving averages, and moving averages start to turn. That's where I feel the risk reward is most in my favor. And I'm going with some momentum rather than getting in early, hoping I've found the low and that the upward momentum will then start to build.
Okay. All right. Last couple, BMN.
Bannerman. So I've got this stock myself. There's my entry point just here, as it was same patterns we talk about all the time: below the averages to above, sideways consolidation, breakout. There's my entry, and I've let this run, wide trailing stop. I've had to see off a couple of pullbacks. This one in particular, that's about 30%, I think. So that's why the trailing stops are wide, to stay on stocks which have a tendency to move around a bit. I'm still holding my stake in Bannerman. I'm not keen to, and I've been talking about this in my weekly strategy sessions. I'm not overly enthusiastic about buying a whole lot of uranium at current levels, because I think there's a potential for a more consolidation in the uranium space generally, because it has the uranium price itself. I can actually click on the uranium price here. See, the uranium price, like Bannerman's making a new high, and Paladin is making a new high, another local stock. And Cameco, the uranium play in Canada, big listed company, it's made a new high, but the uranium price hasn't. So I think there's a potential for the uranium price to come back and just do more work over the next few months, which would then potentially cap the uranium stocks. So that's why I'm not so fired up about buying into the stocks now, although I'm happy to let them run. I don't want to take profits because I could be wrong. The call just could start charging higher. So I don't want to cap my upside, but I don't think it's an asymmetric entry point.
Okay. What about DXB? Last one.
DXB. Yeah, upward trend. The structure's positive. It's above the rising moving averages. Same story there. Bit of a range at the moment. So it's had a pullback to the moving averages. Had a pullback to the averages and rallied. So is it going to spend more time in this range, or is it about to go now? And of course, I don't have the answer to that. So maybe it's a case of, if it comes back to around these lows from April, maybe just back below the 50-day moving average, maybe it's you could have an order at 28.5 to pick them up on a pullback, and then you got a stop loss that's just back below the 100-day moving average. So it's a relatively tight stop loss. You could run. It's a low price stock, so it's still a bit, because it's still reasonable. It's 15%. That's 15 to 20% on a low 33-cent stock, which could go a long way. I think that's reasonable. Or it's buying the breakout. It's getting in around maybe 39.5, and then you get the potential for it to. It's a sort of stock which could double, very much. If you in it, if you were to buy the breakout, then you're probably looking at a stop back. It's probably around 20%. You've probably got to come back midway into the range. But yeah, definitely an interesting stock. I think there's worth keeping an eye on it.
Okay, fantastic. Thank you very much, Jason, for having a look at all those stocks from our viewers today. Thank you very much for answering some of those questions that we had. I'm sure we'll have a few more for next week to carry forward. There is a couple in there, so which we will do. Apologies if we didn't get to your question today. Obviously, we're just going to be a bit conscious of time, which we always go over anyway. But much appreciated having all the viewers here as well, right? Being able to be here and interact with us. It's great. It's great to have. All right. Any closing comments, Jason? Or
no, I think I made enough comments. So thank you for everyone for sticking with us for all this time. Hopefully that's been interesting and helpful, and a few ideas from it.
Yeah, fantastic. Well, you know where to contact me or contact us. It's selfwealth.com.au. Just go on the website and check us out there. Don't forget to like and subscribe these videos or the channel. And then you've also got Jason at motiontrader.com.au. You can check out the links down on the description there. It's pretty simple to find us these days if you really need to track us down. All right, so all good. Thank you very much, everyone, and we will see you next week. Take care. Bye-bye.